All right, next we're going to talk about Chapter 6, Audit Objectives, Responsibilities and Objectives. And so here's where you really get into the meat of things. And, you know, actually most books, or the books I've seen or taught out of, before you get to even this, they talk about what the steps you take to even retain an audit client, but I suppose we'll talk about that at some point. But anyway, the assumption here is that you've accepted employment, you've accepted the engagement by an audit client, you've vetted them, and everything indicates that they would be a good audit client. And so here is what we're trying to do now that we have this audit client. So first thing we'll talk about is explaining the objective of conducting an audit of financial statements, and for public companies also the audit of internal controls. If you recall, in a previous chapter, PCAOB indicates that you must, in your audit of financial statements, at the same time conduct an audit of internal controls. And both on the purpose of both audits is to render, for the CPA firm to render an opinion on the financial statements as well as the adequacy of internal controls. The primary focus is on the financial statements, though, and again, if you recall, we've talked about this many times, maybe ad nauseum, the fact that the audit is to provide the statement users with an opinion by the auditor of whether the financial statements are presented fairly, or, as some say, fairly stated, in all material respects, in accordance with the applicable accounting framework, which here in the United States is GAAP. Notice it says presented fairly. Notice it says in all material respects. And again, the point here is simply to make an opinion, but again, this is not a guarantee of correctness by the auditor. And so they talk about the steps to develop the audit objectives. And so the first thing they talk about is understanding the objectives and responsibilities for the audit. What are the management's responsibilities? What are the auditor's responsibilities? And then we'll talk about dividing the financial statements into cycles. Breaking this up into individual cycles makes the audit process a much smoother process. No management's assertions about the financial statement. The financial statements and the notes and the MD&A and all that stuff that goes with the financial statements are all management's assertions about the financial health of the company. And so we have to know as auditors what those assertions are. Know the general audit objectives for classes of transactions, accounts, and disclosures. And last but not least, know specific audit objectives for classes of transactions, accounts, and disclosures. So we'll look at each one of these more closely here. And so first we'll distinguish between management's responsibility. They have certain responsibilities, and then what the auditor's responsibility is. And so management's responsibilities are that they must maintain adequate internal control, and they have to adopt sound accounting policies, and they must make fair representations in their financial statements as to the financial health of the company. That is a management responsibility, not the auditor's. And so in doing so, they make certain assertions about the financial position of the company. And in the case of a public company, they make certain assertions about the internal controls of that company. Notice that Sarbanes-Oxley for publicly held company has made additional responsibilities for the CEO and the CFO. They must sign off on the financial statements, certifying that the quarterly and annual financial statements fully comply with the requirements of Securities Exchange Commission Act of 1934, and that the information contained in the financial statements are fairly represented. And failure to do so could be not only financially devastating to these individuals, but also could result in possible incarceration as well. And so here you see an example. IBM has their CEO and CFO sign off on this report of management. This is the management responsibility. This is outlining what management's responsibility is. And so if you knowingly falsify this certificate, in other words, if you state that the financials fairly represent the financial position of the company, and you're the CEO or CFO, and you knowingly falsely certify, this could bring about some pretty stiff penalties. As far as the auditor's responsibility, what the auditor's responsibility is to report on any material misstatements in the financial statements, and render an opinion stating that either the financial statements are free from material misstatements, or if not, they must communicate that as well. And so they have to do so after obtaining reasonable reasonable assurance of the fact that these financial statements are free from either fraud or error. Now, reasonable assurance, again, as we've indicated quite a bit, under the standards of auditing, are still a fairly high standard, but again, the auditor is not a guarantor of results. They do not reconstruct the financial dealings of the company. They're not a guarantor. They can't provide 100% assurance that the numbers are correct. Let's talk about fraudulent reporting versus theft of assets. Usually your biggest problems with income statement or financial statement misrepresentations, if you will, are in fraudulent financial reporting. Usually, fraudulent financial reporting of a company is not done by lower level employees. This fraudulent financial reporting usually is done at the highest levels of the company. And so they're usually the largest dollar amount of difference between what the company's real financial position is versus what they represent it to be. And so if you've got some company with management who's decided that they're going to falsify invoices to pump up the revenue and thus the income, thus the shareholders' equity of the company, again, what the auditor does is based upon sampling. They test a very small sample of the overall transactions that occur within the company. And so, you know, if you read the opening to Chapter 6 about this company, Satyam Computer Services, you know, if management wants to circumvent and fake the numbers, they want to perpetuate a fraud, they're going to find a way to do so. There was another company, Health South, back in the early 2000s that the CFO and the CEO got together and decided that they were going to pump up their revenues. The CFO had worked for the auditor that was auditing their financials for a certain year, and the CFO knew from previous experience that the auditing firm that was auditing them didn't audit invoices below $2,000. And so what the CEO and the CFO did was they conspired to create just tons of sales invoices, and every one of these sales invoices was under $2,000, but there were so many of them that it pumped up the revenue by millions and millions. So in that case, the only way that anybody got caught was the CFO started to have a guilty conscience and turned himself in. Otherwise, that fraud may have gone on for quite a while. So again, fraudulent reporting is by far the biggest problem. Theft of assets, usually that's occurring at a lower level. Usually it's much less of a problem. But I guess in the aggregate, if you have a bunch of lower level employees stealing stuff from the company, in the aggregate, the sum of all the thefts could turn out to be a material misstatement of the financial condition of the company as well. So just keep that in mind. And so they talk about professional skepticism and the aspects of that, and you always have to be skeptical of, you know, you can't be too trusting of the company. Again, back to the Satyam example, one of the big mistakes that the auditing firm made in that audit was they allowed the company to send out confirming reports to their customers, confirming the amount of receivables owed by that customer at the end of the year. One thing we'll talk about is the fact that the audit firm allowed that these confirmations were allowed to come back to Satyam before Satyam gave them to the auditors. And what you'll learn is that the proper way to do that is for the auditor to send out the confirmation of receivables owed directly to the customer and ask the customer to send it directly back to the auditor. That way it doesn't get into the hands of the audit. There's much less chance of mischief happening. Not total, but at least it reduces it quite a bit. So you have to be skeptical about the representations that management makes. You have to be skeptical about your judgments. You have to withhold judgment and not be so, I guess what the word I would use is gullible. Don't be so accepting of what management's representations are telling you. Find out what the evidence says and let that draw your conclusions. And so you have to have a questioning mindset. You have to suspend the judgment until you get all the facts and evidence in. Now again, your responsibility is for detecting errors and fraud, material errors and fraud. You're not there to detect every error that the company might make, but you are responsible for errors, not only isolated errors that might be material, but errors that in the aggregate are material as well. So you have to consider that. The other thing they talk about is the fact that if there are laws and regulations with a direct effect on the financial statements, the auditor has some obligation to discover that, and if the company is not in compliance with a law or regulation, they have to realize what that means. And so the direct effect of the audit client not being in compliance with laws and regulations is that there could be some errors and possibly fraud in their representations. You know, if the EPA is about to shut the audit client down or about to file suit on them, a pretty substantial suit for the client, but they've not disclosed that, and the auditor finds out about it, you know, certainly that would have an effect on the disclosures of the company, or should, and it might lead the auditor to do a number of things. Number one, report the problem to the proper parties inside the company, which is the audit committee for the board of directors, and then if the problem is not resolved, possibly either issue no assurance, no opinion, basically, or possibly just withdraw. Why would you want this company to be your client? So withdrawal is always an option. And again, we're talking about substantial non-compliance with laws and regulations, something that would have a material effect on the financial condition of the company, not just, minor stuff. And so certainly if they suspect, they need to inquire of management. They possibly need to talk with the auditor. Should have their own counsel, and so if the auditor believes that the audit client's not in compliance with some law or regulation, they should consult with their own attorneys, and then possibly consider accumulating more evidence. And then if the auditor absolutely knows there's a violation of a law and or regulation, they have to consider the effects on the financial statements, consider the effect on relation with management, and communicate with the audit committee, as I mentioned, and then act accordingly. All right, so what we try to do is we try to break this audit down into what they call financial statement cycles. And this helps us to classify transaction and account balances easily, or more easy, let's say that. And so normally what we do is we break these down into 6 different cycles. And if you look at figure 6-3 and some of these other pages as well, you see there some of these cycles. So you have the sale, well actually it's 5. It's sales and collection cycle, the acquisition and payment cycle, and the payroll and personnel cycle, inventory and warehousing cycle, and capital acquisition and repayment cycle. Now notice that there's some overlap of these cycles, but we try to compartmentalize these. It makes it a lot easier to audit the different cycles, but there is some overlap. So the next thing we want to talk about is why the auditor obtains a combination of assurance by auditing classes of transactions and ending balance in accounts, including presentation and disclosure. And so here what you're trying to do is you're trying to set both general objectives as well as specific objectives based upon management's assertions. They've made certain assertions for each category, and let's just kind of show you here. What they're talking about here is balance and transactions affecting balances. So here we have an example of a beginning balance of AR. And then if we look at our sales for the year, that adds an additional $144,328. Where would you find that? You would find that in the sales journal, right? And then on top of that, what we have is $137,087 of cash receipts. You would look for that in the cash receipts journal. And then on top of that, you would have sales returns and allowances, and charge-off of uncollectible accounts. So those are things that would be in our I'm looking for it. Sales and collection cycle, basically. All this is part of the sales and collection cycle, right? You've got these different journals. You'd have sales returns and allowances, and as well as your write-off for bad debt. All right, so here we're distinguishing among the three categories of management assertions about financial information. And if you look at look at table 6-2, this gives you an idea in summary of what we're talking about. And so management makes assertions about classes of transactions and events for the period under audit. That would be the left-hand column. They make assertions about 5 things. They make assertions about the occurrence of transactions. They make assertions about completeness of transactions and events. They make assertions about accuracy, classification, and cutoff. Now, the occurrence assertion means that they're asserting that certain transactions and events have occurred. The completion or completeness assertion by management simply says that all transactions and events that for the year have been reported in that year, not some other year. Accuracy just says that the assertion is that the numbers are accurate, have been recorded appropriately. Classification assertion just says that they're recorded in the proper accounts, and then cutoff simply means that they were these transactions occurred in the correct accounting period. Now, as far as assertions about account balances, the first deals with existence of account balances, and so there the management is just asserting that assets, liabilities, and shareholders' equity accounts do exist. The ones that should exist do exist. The completeness assertion concerning account balances simply says that all assets, liabilities, and equity interests that should be reported for the period are recorded. And then valuation and allocation simply says that assets, liabilities, and equity interests that are included in the financial statements are reported at the appropriate amounts, and valuations are properly, or adjustments are properly included, such as, again, our receivables less allowance for doubtful accounts, the net realizable receivables are accurate and valued correctly. And last but not least, certain rights and obligations are asserted about account balances, meaning that the entity holds or controls the rights to assets, liabilities, or certain obligations of the entity. Going to the assertions about presentation and disclosure, there you have assertions made about the occurrence and rights and obligations. And so there, what the management is asserting is that disclosed events and transactions have occurred and pertain to this particular entity. The next assertion is completeness, and notice how some of these correspond all the way across. Certainly does here. And here, management's asserting that all disclosures that should have been included in the financial statements have been included. The next is dealing with accuracy and valuation. We've talked about that already. And then the other assertion that management makes as far as presentation and disclosure deals with classification and understandability, and they're asserting that the financial and other information is appropriately presented and described, and disclosures are clearly expressed. Now, from there, what we do is we take that and we build our objectives, both generally and specifically, in determining our audit plan. And so here they have PCAOB's assertions that we have to determine Notice that the first three, existence or occurrence, completeness, and valuation or allocation, deal with balances and transactions, where the other two, rights and obligations, presentation, and disclosure, well, especially that presentation is treated as a single assertion. And so here we're going to link the 6 general transaction-related audit objectives to management's assertion for classes of transactions. So here we have our 3 general transaction-related audit objectives. Occurrence, again, what we're looking for is to see that recorded transactions actually exist. Completeness, what we're looking for to make sure that all transactions for a certain period have been recorded in that period. And then accuracy is simply that they're stated at the correct amounts. And then, so if you look at that, going back, that's our general transaction related audit objectives. And if you look at table 6-3, I think this illustrates illustrates it much better than what we have on the screen. Under accuracy, we have not only just accuracy, but we also have posting and summarization, which deals with sales transactions being properly recorded in the master file and correctly summarized. Next, we have a management assertion of classification. Our general transaction related audit objective deals with classification as well. And here they're relating it to, again, in this example in table 6-3, to this company's sales transactions. That's a big part of transactions, is sales transactions. Not everything, but a big part of it starts with sales transactions. And so classification, these sales transactions are properly classified, and then timing just says that they're recorded on the correct dates. And so notice how we go from management's assertions about classes of transactions and events, and then we have our general transaction related audit objectives per PCAOB and the AICPA as well. And then you have your specific transaction-related audit objectives, in this case, in this example, related to sales transactions. So it all fits together. It goes from management's assertions on the left to our general audit objectives to taking those general audit objectives and relating them specifically, in this case, to sales transaction-related audit objectives. Here we're making sure that recorded sales are for shipments made to real customers, not fictitious customers. For completeness, we're making sure that sales transactions, all the sales transactions within a period are recorded. We're making sure that they're correctly billed and recorded for accuracy. As far as posting and summarization, we're making sure that sales transactions are included in the master file and correctly summarized. As far as classifications, we're making sure that the sales transactions are properly classified as sales and not something else. And then cutoff, dealing with timing, making sure that all sales transactions for a particular period, accounting period, are recorded on the correct dates. So you're going from general to specific. So again, you're just linking your audit objectives, both general and specific, to management's assertions. And here's some others that are included. Detail tie-in. Account balances, well, we talked about that. Account balances agree with master file amounts and with general ledger. And then assets are included at estimated realizable value. And again, this is kind of the general assertions of management. You're trying to relate back to those. You know, that would be in a different cycle. Although even in the sales and collections cycle, one of your assets would be accounts receivable, and you would want to make sure that they're included at the correct estimated realizable value. So it relates to sales, it relates to all cycles. Rights and obligations. Assets must be owned. Now that, how would that deal with sales cycle? Well, what if you have assets that you're holding and selling on consignment? In that case, the company could not report those assets as being their own because they're just holding them on consignment. And so again, here they're taking management assertions and taking those with our general balance related audit objectives and specifically relating this to and applying this to inventory. And so again, existence is management's assertion, excuse me, same for our balance-related audit objective here, related to inventory. And then here we're specifically applying the objective to inventory. And what we're doing here is we're making sure that all recorded inventory exists at the balance sheet date. And as you see here, we go on and on with it. And so you can take these management assertions about account balances, take our general balance related audit objectives. Most of them are pretty similar to management assertions, not exactly the same, as you can see. And then from there, we can apply it to these cycles as it relates to existence, completeness, accuracy, classification, cutoff, detail, tie-in, realizable value, and rights and obligations. So next we want to talk about linking the 4 presentation and disclosure related audit objectives to management assertions and disclosure. And so here what you're looking at is table 6-5. And again, management's assertions about presentation and disclosure include occurrence and rights and obligations. So occurrence and then rights and obligations. That's our same general presentation and disclosure related audit objective. And then we take that and we specifically apply it to, in this case, notes payable. And so what we're trying to do is make sure that notes payable, as described in the footnotes, exist and are obligations of the company. How might we do that? Well, in our collecting evidence, we might want to send notifications or verifications of to the other party to the notes payable and have them confirm that the notes payable exist and are obligations of this particular company. Next we have completeness as a management assertion, and again that's our general objective. And so here our specific objective as it applies to notes payable is to make sure that all required disclosures related in notes payable are included in the footnotes. Next, management assertion is accuracy and valuation. Same for our general objectives, and so we take that and specifically apply it to our notes payable Here what we're looking for is to make sure footnote disclosures related to the notes payable are accurate. And then last but not least, classification and understandability. Same for the general objectives. Here, applying it to notes payable, what we're looking for are to make sure that notes payable are appropriately classified as to whether they're short-term or long-term obligations, and related financial statement disclosures are understandable to users. Okay, so notice there's a pattern here. Management assertions, general objectives, and then specific objectives are applied to various parts of the transaction cycles. Next, we're going to talk about the relationship between audit objectives and the accumulation of audit evidence. And so audit objectives are met by the auditor obtaining sufficient appropriate audit evidence to support all management's assertions in the financial statements. And so the audit process has 4 phases. First, we plan and design an audit approach. And so the main considerations there are making sure that we collect enough sufficient, appropriate evidence to meet our professional responsibility. Now, that's based upon our assessment of the company and their effectiveness of internal controls and all that. Understanding the company business and the environment in which they operate, the whole 9 yards. And what it boils down to is we assess audit risk based upon the effectiveness on internal controls, and the better the internal controls of the company against error or material error or misstatement, the less evidence we have to accumulate. Phase 2, perform tests of controls and substantive tests of transactions. Phase 3, perform analytical procedures and tests of detail of balances. And Phase 4, complete the audit and issue an audit report. And so, going back here, Phase 2 through 4 we'll talk about more, I'm sure, here in the days coming, but let me just kind of touch on performing tests of controls and the other 2 phases as well. And so the first thing they have to do is test the effectiveness of the internal controls, and so they do that by observing many times. They run their own tests as well, independent of what the firm is doing or the company's doing, the audit client, and things like that. And the same goes for the substantive test of transactions. They may run some dummy transactions through the accounting process or the accounting system to see if they're being recorded accurately. So the next, perform analytical procedures and tests of details of balances. And so the analytical procedures consist of evaluations of financial information through analysis of plausible relationships among financial and non-financial data, And the example they give is to provide some assurance for the accuracy objective for both sales transactions and accounts receivable. The auditor might examine sales transactions in the sales journal for unusually large transactions and compare those with prior years. Tests of the details of balances. These are specific procedures intended to test for monetary misstatements in the balances in the financial statement. And the example they use there is related to the accuracy objectives for accounts receivable. And what they talk about is testing the details of ending balances. Normally they do that, like we talked about, by confirming, sending a confirming notice to, let's say, a sales customer, and asking the customer to confirm that they owe whatever balance the company is reporting that they owe at the end of the year. And then, last but not least, complete the audit and issue an audit report based upon phase 1 through 4, or 1 through 3. All right, so that ends our talk of Chapter 6.